Are you a property investor? Did you know there were 5 benefits in the Spring Statement that most commentators have missed? Oh, and stay tuned to the end because we have a bonus 6th one too that we've just found. Welcome back everybody, and today we have some fantastic news from Tej Gill of Ninja Accountants, who joins us once again. Tej, welcome today. What's the topic that we will be talking about?
So most people would have seen last week Rishi Sunak was giving his spring statement with a few juicy headlines, but we're going through some of those points and picking them apart to go into a bit more detail, things people may not have seen or heard, and also some of the implications of those things.
Superb. So if you've not already subscribed to this channel, subscribe now, because what Tej is going to be sharing with you is 5 things that you will have missed in the property budget and how they affect you as a property investor. We'll also be looking at a bonus item at the end, so make sure you stay tuned to the end because there is a 6th bonus. We always like to give that bit more than we promise. So, Tej, just setting the scene here. Rishi Sunak, he said borrowing as a percentage of GDP is going down. So it gives him wiggle room to play with the budget. And a lot of commentators have sort of looked at it and sort of said, well, you know, all he's done is given with one hand, taken with another, and it's a smoke and mirrors budget. But let's have a deep dive into those 5 topics. Now, the first topic we're going to discuss today is national insurance and how that affects property investors. So, Tej, do you want to give an introduction to that and why this is an important one for some but not all property investors?
Yeah, absolutely. So the headline is that the national insurance threshold is going to increase by around £3,000, and that essentially brings it in line with the personal allowance for income tax. So the benefit here is that there was always a mismatch. So the old threshold was around 9,500 and the personal allowance was around 12,500. So there was this disconnect where you would pay no income tax up to £12,500, but you would start paying national insurance. And once you start paying national insurance, then obviously you have not only the employees, but you have the employers' contributions that start to be paid as well. So by increasing that threshold and bringing it in line, you know, the amount of money you can take before you have to pay any kind of tax, and let's be honest, national insurance is a tax.
Yeah.
It aligns with the personal allowance, and you can take that sort of £1,000 odd a month without needing to pay anything over to the government. But back last year, Rishi Sunak announced a 1.25% increase in the national insurance rates. Now, a lot of people are hoping that might disappear in this spring statement. It didn't. It's still there. So although he's giving a £3,000 uplift, there's still this 1.25% extra to pay once you do start paying. So there's a tipping point where there's a benefit of the increase in the threshold, but then once the 1.25% starts biting, then you lose, the benefit starts disappearing essentially. Now, for property investors, the thing here is that, sorry, going back to what you said about the giving with one hand and taking with the other, this is pretty much an example of that. And for property investors, the main point here is most people will have their own limited company that they're running their property business through. They'll be taking a salary from there. So most people are taking just that base level of salary, and most were wanting to keep it below the national insurance threshold. So the thing here is you can now increase that slightly, take your basic salary up to the personal allowance level, and then it just aligns those 2 things. There's a little bit more out each month, and I'll cover your fuel bills. And the thing with the difference everybody always makes up with dividends will remain in place.
So there's 2 things that I'm picking up here that I think the audience need to look at. Number 1, if you're still running your property business as a sole trader or a partnership, you won't get the benefit that those who have incorporated their property business might. Now, I know that's something that we have as a topic to come up in future videos for you, so make sure you hit that subscribe button and smash the like button so that Tej knows you want to hear about that video. The second thing here, and I'm not saying you've missed this, Tej, but as an employer, the employer also gets what's called an employer's allowance. And the first £4,000 last year was exempt on the national insurance. Now this year that's increased to £5,000 for employers. So the bit that you would be paying as an employer, £5,000 of that you can claim the employer's allowance for national insurance on.
Yeah, that's right. So that's actually point number 2 we've got into there, which is the employment allowance has increased from £4,000 to £5,000. So this is actual real money. So this isn't a threshold at which you start paying tax. This is you calculate your employer's national insurance in your company, and then you take £5,000 off what used to be £4,000. So there's £1,000 net benefit there. To get the employment allowance, you have to have more than one payroll employee. Again, for a lot of the audience who tend to have maybe their spouse on there as well, or working with a partner, that should be there. There should be 2 people on the payroll, so that's a benefit. And I guess kind of thinking a bit wider as well. There, on the one hand, we're looking at this from the point of view of the actual investor, but also thinking about the tenants, the people that are in your property. If there's these increases in national insurance thresholds and employment allowance savings, they may feel a bit more secure in their employment as well, and their employer may feel a bit more secure in their employment. So they can, the worry about missed rents and the moratorium on removing tenants and everything like that, there's that sort of shadow benefit to property investors, that actually your tenants are a little bit more secure with these increases as well. So you should, there should hopefully be less defaults and less voids.
Yeah. So what we're effectively saying is the employment allowance gives more job security for tenants. And if you watch the previous video that Tej and I released on the property market update following the Spring Statement, then you'll see some of the benefits of what we were referring to there replicated into this employment allowance. So Tej, we've done 2, national insurance and employment allowance. Number 3, annual investment allowance. Now, property investors, we do something called investing. Does that mean we can claim an allowance for every house we buy, every commercial premises?
If only. No, so the annual investment allowance is for qualifying sort of plant machinery. So there may not, for straight buy-to-let investors, it's not going to be relevant, but a lot of people are moving into already in the serviced accommodation and serviced office buildings, and for them, the annual investment allowance is a great thing. Really, it saves them up to £1 million of investments in those buildings, in those properties. So that's a real saving, and it's something that it was introduced a number of years ago, and the government extended it, and now it's extended up until next March. So one thing that was sort of deep in the blurb, if you like, for the statement, was about overhauling the capital allowance system as a whole, because we had the super deduction announced, we've got this annual investment. It's all been a bit reactionary and a bit bitty. So the government are looking at the capital allowances regime as a whole, which is capital allowances, essentially your tax depreciation on plant and machinery and things like that. And a few of the sort of headline points they're considering is having a permanent £500,000 annual investment allowance, a couple of % increase on the allowances that you can write down, higher first-year allowances. But these are just sort of, I guess, working thoughts from the government. They are looking into it, and over, I think, the next 12 months, they're going to come out with a plan of what the capital allowances will look like in the future. So for property investors, in investing in those kinds of properties, watch this space. There'll be some announcements that should hopefully make these schemes more permanent, and you can therefore kind of invest with more confidence, because the super deduction is falling away next March. At the same time, that the corporation tax rates are going to start going up if you're making sufficient profit. So, you know, there's that I guess as another word of caution, I suppose, is to make sure that you invest based on your cash flow capabilities. While the 130% deduction is, you know, very attractive, the 30% extra you're getting on the deduction, the corporation tax rates are going up by 30%, you know, this time next year. So invest on the basis of the cash flow that you have in the business, and don't overstretch just to get the 30% today, because you are still going to pay 30% more in corporation tax from next year.
Well, I think that's a very wise bit of advice there. And it's about cash flow is king. You know, turnover is vanity, cash is sanity. And I think you've nailed it on the head there with that particular statement about being cautious. So to review, we've looked at the national insurance, we've looked at the employment allowance, we've covered the annual investment allowance, we've talked about an overhaul of capital allowances. Surely there can't be any more allowances as good news stories for property investors, can there?
Just one more. The research and development allowance. Yeah, the research and development allowance, R&D allowance. So the scope of this has been widened. It now includes things like cloud computing and all this other stuff. But I guess the thing with R&D is most people think it's all about, you know, rocket ships and you know, computer chips and robots and all that sort of stuff. It's not. It's just about improving processes. So the tip here is that actually, even in a property business, even in a property development business, or, you know, builders or things like that, if you're doing things, if you're trying new innovative building techniques and something a bit novel in your approach, even if it's, I've seen some people make claims for just for their project management being different. They've taken a new approach to the project management, and they've managed to claim some R&D allowances for that. So don't think that it's just got to be, you know, some sort of laser guided missiles that you're developing and that's all that you can get R&D allowances for. Look at your business, engage an expert. I mean, we work with people on this. We don't have the people in house to do it. We have you know, partners that we work with, and there is potential there for a lot more businesses than we think that can get these R&D allowances, and they can be quite significant.
So Tej, it's a really great tip, that R&D allowances, because I've claimed it on a couple of my businesses before, and I got £2.30 worth of tax relief, and I did exactly what you were saying there. It was about implementing innovative new processes into the business. So it is worth claiming, and it is substantial money that you can claim as well when you look at what's there. So it really is worth reaching out to an expert such as Tej, who can help guide you through that process. Now, if you like the idea of finding out a bit more about research and development allowances, tell us in the comments below and we will make a video for you deep diving that and how you could utilise it within your property business. So Tej, point 5, let's go there. What have we got?
Oh, so point 5 is a bit doom and gloom. So buried deep in the notes was various amounts that have been made available for tackling, shall we say, illicit behaviour. And one thing that was buried deep in there was 48.8, very specific number, let's call it £50 million available to tackle fraud. So the government are making an extra £50 million available to HMRC to investigate and tackle fraud. This is separate. They've got another budget for, say, tax credit fraud. This is specifically for looking at for financial fraud and financial crime, which could include where people may have taken bounce back loans in positions where they should not have taken bounce back loans. We've all seen the examples of where people have taken a bounce back loan trying to close the company, or directors who've been struck off for claiming more than one bounce back loan in the same company. So, you know, the government are looking at this very seriously. They put money aside to look at it even more seriously. So, you know, it may be something that people need to consider in terms of cash flow, because I know there was this whole debate, should you take the bounce back loan and buy a property, should you not? I know some people did, I know some people didn't. if you did, it may be time to consider whether that was the best move and take some advice on it and think about what next steps you might want to take.
Well, I think what I would point out there is those people who've been long-term subscribers to this channel will see I did a series of videos on the bounce back loans and how I was quoted across a number of YouTube channels and interviewed elsewhere on this as a figure of authority on the topic. And I always urged everybody to do ethical decision making around this. And I was even quoted in the Sunday Times and held out as somebody putting out the right message to the marketplace. Therefore, do the right thing. Look at yourself now before HMRC catch up with you. What I'd recommend you do, if you're not already, is subscribe to this channel, because I will keep you updated with relevant experts such as Tej Gill of Niger Accountants, a fantastic firm, really great guy, invests in property himself as well, and we work together quite extensively on that front, don't we, Tej?
Yes, we do. I've learned a few things along the way from you, Andrew. So yeah, it's nice to.
You're so kind. You also heckle me occasionally as well.
Oh well, yeah. Obviously, you've got to, right? You can't just be nice all the time.
Absolutely. So, Tej, where are we up to with our review? Because we've done national insurance, we've done employment allowances, annual investment allowances, overhaul capital allowances, research and development allowances.
So I think, I guess the general point, the last sort of takeaway for me from the budget as a whole and all the messaging around it was that despite what's going on in the world, despite what the whole world's just been through and what is going on now, it was actually very much a positive kind of forward-looking statement. Very much jam tomorrow. We mentioned previously about the tax receipts being up and the debt to GDP ratio is on the slide, coming down. So these are positive things, which mean that the UK economy is probably in a stronger position than many people would have thought coming out of COVID and then into geopolitical issues. And I think that is probably something that really came through in this. They're very much wanting people to invest. All those allowances that we talked about are designed to get people to invest their money. And that's really the way that they want this to go, grow the economy, grow the capabilities in the UK economy to generate more GDP in the future. And obviously with those corporation tax increases, that will further swell the government coffers. And there was a mention about an income tax cut from 20 to 19% by 2024. If the receipts carry on going up, I'm sure there'll be other incentives put out there as well to encourage further investment.
Well, I think it's not wishing to sound political, but we've hit a period in our economy like we've never experienced before in our lifetimes. The closest thing is going back to sort of 1914 and the First World War, where it shredded the economy. But I think what it's a testament to is Rishi created policies, and okay, some of them help out to eat out, or eat out to help out, whichever way round it is, I can't even remember, were designed to stimulate the economy. And because we're saying tax receipts are up and borrowing as a percentage of GDP is down, those measures appear to have played their part in stimulating the economy. And these allowances now are designed to get us to invest further, to leapfrog ahead as a global power house. Would you agree with that, or do you have a contrarian view to me today?
No, I agree. I'm no massive fan of the Conservatives, no massive fan of Labour or anybody else, but you've got to give some credit that actually handing out money for almost 2 years on furlough and business rates rebates and everything, to actually be in a position where now the bank balance is looking good. It shows good management of the finances of the country, and that that is a positive thing. The economy drives, everything else, education, crime rate, everything is off the back of the economy. So it's important that is strong. And so you've got to give credit where it's due. In terms of leapfrogging ahead, I think we're a little way off that. I think our productivity compared to, say, the other G7 countries is at about 60% of what they do. So I think it's a case of catching up before we're thinking about leapfrogging. But even catching up to be at the same level will make a massive difference to a lot of people.
Well, I think on that note, Tej, we'd better wrap this video and get some productivity done. Otherwise, we'll fall behind further.
That's it, stop yapping away and actually go do something.
Yes. So thank you for subscribing. Thank you for liking and commenting on this video. Do you agree with the 5 points and the bonus point there that we've picked up out of this budget analysis will benefit your property business, or do you think it was a complete wet blanket? Tell us in your comments below. And Tej, a massive thank you once again. Tej Gill, Nidger Accountants. Brilliant commentary, brilliant input, and always looking at it from a different perspective to other commentators out there. I love it, Tej. It's thank you from me, Andrew Roberts.
And thank you from me, Tej Gill.
And we'll see you in the next video soon.